All right. Good afternoon, everyone. It is 2 p.m. Central Time, so we're going to go ahead and get started to honor everyone's time. Thank you for joining today's webinar on the Clergy Housing Allowance. It's really the continuation of a previous webinar with some Q&A. There'll be a little recap. If you have questions, please in the chat send any questions you have to the panelists, and that way we can get those answered. And everyone that has registered for this webinar, you'll receive an email, a follow-up email after this with a copy of slides that you see here, as well as some iteration of the recording from today's session. So with that, I'm going to turn it over to Bryan Mills.
Thank you, Jensen. Good afternoon, everyone. For those of you who aren't aware, my name is Bryan Mills. I'm the General Counsel for GCFA. As Jensen mentioned, this is a follow-up to an existing webinar that's available on GCFA's website on the tax packet page. If you haven't seen it, Jensen, if you get a chance, will you throw a link to it in the chat for everyone? There's other documents on the tax packet page beyond just the webinar, and it covers more than just housing allowance issues. It covers other tax related issues as well. So I would commend that entire website link to you. What I'm going to do is a very initially here at the beginning, a shortened version of the webinar that's on the website. I'm just going to go through a few slides with everybody to kind of set things up. I'm going to focus solely on the housing allowance. If you've looked at the webinar, I cover all 4 of the special clergy tax rules. So once I'm done with that little intro, if you have questions on the other rules, not just the housing allowance, feel free to put those in the chat as well. We'll cover as many questions as we can in the time allotted. Please don't hesitate to put something in the chat while I'm talking. I'll eventually see it. If I can address it right then, I will. But with all of that out of the way, I'm going to share my screen here really quick. And we'll go through these. I'm going to do this fairly quick. And so we can get to the questions. And if there's anything that doesn't make sense, please, like I said, put a question in the chat and we'll get to as many as possible. So again, there's 4 special clergy tax rules we're talking about here. One of the 4, which is the housing allowance. It is something that is embedded into the tax code. You can see there it's section 107 of the tax code. That's for those of you who really want to be overachievers and go look it up, it's 26 USC section 107. And it allows ministers to do one of 2 things. It's exclude from the gross income either the fair rental value of a home that's provided as part of their compensation. So in our parlance, that would be a parsonage, for example, or to exclude from their gross income the parsonage or housing allowance that the clergy person uses to provide a home for themselves. It's important to understand it's an exclusion, not a deduction. And the distinction there is that exclusions from income don't show up on the 1040 and are not reported on the 1040, where a deduction is something that is taken out at some later part on the form. So it's initially whatever money was used towards that deduction shows up in taxable income initially and then is deducted out at some later point. The amount that is excluded never shows up from the beginning, if that distinction makes sense, hopefully. The other thing that's very important for clergy to understand here is that while those 2 items, either the fair rental value of a home or the parsonage or housing allowance used to provide a home, are excluded from taxable income, they are not excluded from taxable earnings when calculating Social Security. So to say it in a positive way, that amount has to be included when calculating SECA taxes. This is, you're not going to use the mouse wheel. That is, there we go. So How does this happen? It happens in a couple of ways. If it's an in-kind provision of a parsonage, then it's just the fair rental value furnished plus utilities excluded from the taxable income of the pastor. That's really fairly straightforward. So again, that whatever that value is doesn't show up on the W-2 in the wage box. It doesn't get reported on in the 1040 on the wages line. It's just simply not included. CAS allowance gets a little bit more complicated, but the rules are still fairly straightforward. It can come up in one of two ways, depending on, you might see other terminology. This is kind of my terminology to try and make it as simple as possible. You might see the use of housing exclusion or parsonage exclusion. If you see other terms, just make sure you have a clear understanding of what people mean when they are using them. But I've provided you with definitions here. So when you're talking about a cash allowance, what most people think of would be the second one there listed, the housing allowance, which is cash provided to cover the expenses that the pastor provides himself or herself. So they've gone out and bought a home, or they're renting their own home somewhere else. Some churches do a parsonage allowance, which is, again, in my terminology, it's still a cash allowance, but it's related to expenses incurred by the pastor while living in the church provided parsonage. Some churches will cover all of the expenses directly. Others, for example, the utility bills may be in the name of the pastor rather than in the name of the church. And so the pastor may have some out-of-pocket expenses in paying those utility bills. So the parsonage allowance might be designated in order to help cover that. And either way, the rule is the same. What's excludable from the pastor's taxable income is the lesser of three things, which we'll get to in just a second. But again, as an important reminder, either of these, the in-kind provision of a parsonage or the cash housing allowance, are included when calculating Social Security tax liability or SECA liability. So when we're talking about an allowance, which means cash, not the in-kind provision of a home, the church has to formally designate the amount of the allowance in advance. That in advance is really important, and that's one of the reasons why we're doing this at the time that we're doing it. With charge conference season and these decisions being made for the following calendar year, it's really important to get it done before January 1. And then what is ultimately excludable from income is the lesser of three things. It's the amount of the designation, the amount of qualified expenses actually incurred, or the fair rental value of the parsonage or home furnished plus utilities. Most of those are fairly straightforward. You know what the amount of the designation is, as long as you're keeping track of your of your expenses, you know what those add up to. But the question then becomes, well, what counts as qualified expenses? And this slide addresses that. I think if you take a common sense approach, you'll be pretty good. The downside here is it's been a long time since the IRS has really said anything definitively on this topic. There's very little official guidance. So for the most part, we're kind of a little bit of a guessing game is happening, but we do know some things that are clearly in and are clearly out. You can see the clearly out list there. Groceries, clothes, music, toiletries, servants. That's the IRS tax code word. That's not our word. But if anybody who's listening to this is working for a church and your income is such that you've got servants, let me know if you're hiring, because I might be ready to apply. But that's probably not much of an issue for most United Methodist clergy to have to worry about. The list of things that are included is longer, and again, it's fairly common sense. Obviously, rent, mortgage, etc., property taxes, insurance. If you need to fix the hot water heater or fix the roof, that would count. Utilities, furnishings, maintenance items, and then Johnny down the street cutting the grass once every other week would be included. The box over on the right, and it's important to understand, this is not a question of whether it's a personal expense or a business expense. It's really, is this an expense that's necessary to have a house, whether you're renting it or whether you own it? And that, there's a reason I mentioned there's not a whole lot of guidance, and there hasn't been much recently. You know, technology has kind of gotten ahead of the curve here. So some folks anymore don't have a landline. Landline would be pretty clearly within the category of owning or maintaining a home, but some folks don't have that now. So does that mean, can you use your cell phone service instead? Can that count as a qualified expense? Probably, but do we have anything that we can point to that says definitively yes? No, we don't. Cable or satellite TV, again, probably. Internet service, I would say probably definitely at this stage. Netflix subscription, is that really at this point much different than cable or satellite TV? I don't think so. But you know, again, we're in the world where we don't have really much in the way of specifics about some of this stuff. But you take a common sense approach. If you have a professional tax advisor, you know, have a conversation about what counts towards it, what you're comfortable with, and what feels too aggressive, and then you just keep records. Quickly shifting gears briefly, you know, what do you do if it cannot all be excluded? So in other words, for example, the designated allowance turns out to be more than the actual expenses. Well, the difference between the two then needs to be reported in the 1040, because it's not going to show up on your W-2. The church will exclude that from what's reported on the W-2, so you'll need to add that difference back in. The important thing here is to try and avoid, if at all possible, any major variance between the designation and what is ultimately excludable based on the test of the lesser of three things. It's better to be too high, in my opinion, than too low, because if you're too low, you can't fix it. That's a lost opportunity to maximize what can be excluded. If it's too high, if it's a little bit too high, not a big deal. You have to report an additional amount of income, and you've got to, you know, cover the taxes on that. If it's way, way too high, then you maybe got a significantly unexpected additional tax burden at the end of the year that is probably not desirable, but it can be fixed. Some friendly reminders, again, just to really, with charge conference season, the things that are really important to remember. It needs to be done in advance. The best practice is for it to happen before January 1. Mid-year changes can occur, but they're only prospective. And I've got an example there that illustrates that. The short version here is, if you realize halfway through the year it was too low, you can't fix it for the whole year. You can fix it for what's left in the year, but it's not going to be a complete recovery and a complete adjustment. So there's going to be a lost opportunity there. So that goes back to really work with the church and the pastor really need to work together each year to make sure the designation is high enough so that there's not that lost opportunity to exclude from income. This is an important thing I always like to mention. You know, that third item on the list, the amount of the designation, the actual expenses, or the fair rental value furnished plus utilities, that can create an unexpected limitation in certain situations. And so this is an example meant to illustrate it. And I don't like reading slides, but I'll do it here. So a pastor annually incurs around $15,000 in qualified expenses associated with owning her home, which is less than the $17,500 annual fair rental value of that house. For 2021, the church sets her housing allowance at $15,000, all of which she was able to exclude from income. Late in 2021, preparing for 2022, the pastor's son, his spouse, and 2 children moved back in. and she doesn't know for how long it's going to be. So she realizes she's going to need more space to keep her family intact and not have everybody go crazy. So she adds an addition to the house that's going to happen in 2022 and be completed. It's going to cost $30,000. She knows this going into 2022. So she asks the church to increase her designation by that $30,000 and asks for it to be $45,000 for 2022. Now there's some logic here, right? She knows her actual expenses are going to go up by $30,000. It's going to spike for that 1 year in 2022 and then go back down probably close to the original 15,000. The problem is that fair rental value limitation. Remember, it's the lesser of three things. The designation, which would be up to 45,000. The actual expenses would be up to 45,000 for 2022. But the fair rental value of the house with the addition is not going to go up by $30,000. And even with housing markets and prices the way they are right now, you're not going to spend $30,000 to add something to your house and be able to rent that house for $30,000 more per year. Might be, you might be able to increase the fair rental value, might go up by a couple $100 a month, but it's not going to add up to $30,000 for the year. So that fair rental value maybe annually goes up to $20,000, but that's still $25,000 less than the designation and the actual expenses. So this is kind of an extreme example, but if you're replacing a roof, you're replacing your HVAC system, and it costs several $1,000s, your actual expenses are going to spike. But for things like that, there's probably little to no impact on the fair rental value for the year. So just something to keep in mind. Again, it's okay for there to be a difference, but this is a situation where if she gets to the end of the year and she realizes I've got $28,000 that I can't exclude, then she's got to come up with the money to pay those taxes on that $28,000 at the end of the year. So just something to be careful about.
Bryan, there's one question that's timely to this that came in. If they have a July appointment, they can designate at that time, correct?
Yes, and that happens very commonly, and it would be designated through the end of the year. And if a pastor is switching appointments, hopefully they had a designation at their prior appointment that would cover them through the first 6 months of that year for the actual expenses incurred then. Really quickly, there is some impacts on pensions. I don't get into the details here. Westpath, General Board of Pension and Health Benefits is where you should go to figure out what this would look like as far as what it means for contribution to retirement accounts and things. And then from the standpoint of pension distributions later in life and retirement, every annual conference every year adopts a resolution that designates 100% of the pension payments received by their respective clergy as a housing allowance. So that designation happens every year. The important thing to know is the least of the three amounts rule still applies. So you know how much is going to be designated. It's all of your pension payments, but you're going to have to calculate fair rental value. You're going to have to calculate actual expenses to determine if there's something less than that is actually going to be excludable. And this is from the slides I'm going to skip over. So just if you're looking for some good resources on this going forward, in addition to what's on the tax packet website, these are three that are pretty good. One is, as you see, from the IRS. Two are books that you can buy. If you want a shorter book, more kind of paragraph form, go with the Dan Busby one. If you're looking for something that can prop up your table if it's wobbly, or used to squash a spider, then get Richard Hammer's book. It's pretty big, but it covers all kinds of tax stuff, but there's a lot of information in both. And at this point, I am going to take this off the screen so I can see what we've got going on.
Brian, the only questions we had left both pertain to, I'm sorry, not the only questions we have. The earliest questions we received pertain to retired clergy. And I think you just covered that right there at the end, that retired clergies are also, let's see, the housing allowance is allowed for retired, but you said to reach out to Westpath.
So if you have questions, Westpath is who you go to if you have questions about, let me give you an example of what I mean by that. So if you have a church that pays its pastor $70,000 a year in salary and then designates $20,000 as a housing allowance, some portion of that $20,000, my understanding is included in the calculation of what the pension contribution from the church is for that pastor. So that's while the pastor is actively working. That's a question to go to Westpath or to the annual conference about if you want to understand how that dynamic plays out. Once someone has retired and is receiving the pension payments, that's where each annual conference every year designates 100% of that as a housing allowance. And then what each individual retired pastor needs to do is calculate the other two things. What's the fair rental value of my house for the year? What are my actual expenses for the year? Compare those three numbers, and the smaller of the three is the one that can be actually excluded. And I'm seeing the next question: is the housing allowance only for appointed pastors, or can retired and extension ordained clergy also benefit from the housing allowance? That question could be asking two different things. If it's talking about the pension payments received, I've covered that. If someone who's retired is currently, but has retired from ministry, but is maybe working in some other capacity after retirement, it's possible but this is where the other parts of the original presentation come in. It depends on what the job is and whether that job falls into category of serving as a minister. As being a minister is probably there, but are you performing services in furtherance of your ministry? That's a threshold question for the special clergy tax rules to apply. So if somebody is working in retirement, if you're serving a church as a pastor for some reason in retirement, then you probably check all the boxes. If you're doing something other than that, it's going to be more of a case-by-case basis to determine if you qualify as a minister for tax purposes in that job in retirement.
All right, we had a question come in that says some clergy have thought that they do not have to have receipts to back up a housing allowance. We have some who elect to take a housing exclusion, and they think that is the only time you need to keep receipts for a tax audit. So I guess the question would be, is that correct?
If you're receiving, if you've been given an allowance, and again, what you can actually exclude is the lesser of three things: the amount of the allowance, the actual expenses incurred, or the fair rental value. Well, you should easily have documentation of what the allowance is, because that's a piece of paper that's adopted by the charge conference at some point that says it on there. So you should have that. The fair rental value, you want some type of documentation for that, even if it's just a brief letter from a real estate professional or something that says, this is how much I think you would be able to rent this out for a year, furnished utilities. And so those are fairly straightforward, and it's probably just one piece of paper for each. The actual expenses is where more documentation is required, and it's just like anything else that you do with your taxes. You want to have documentation to support whatever it is that you reflect on your taxes, because if you don't have to provide those documents when you file your taxes, but if you get audited, the IRS is going to ask for them. So you're going to ask for, okay, you excluded, your pastor, you excluded $15,000 as a housing allowance on a non-tax basis from your income, give us $15,000 worth of documentation supporting actual expenses of that amount. You want to be able to do that. If you've got a mortgage payment, it's probably going to be pretty easy to do. And maybe that hits the $15,000 and you're done. But if you've also included utility payments in there, you want to keep the bills or something that shows that you paid it, some type of year-end report or whatever the case may be. If it's Johnny down the street cutting the grass for $25 every other week and you've included that in there, you're going to need to find something to reflect that. If you've repaired something, an invoice from the repairman, whatever it is that goes into what you add up to the amount that you've excluded, you want to have some type of documentation to support that. Again, you don't have to provide it when you file your taxes, but if you ever get audited, it's going to be asked for.
The questions are flowing now. Here's one for you. Kind of piggybacks on that previous comment, and that is, they said they have a unique situation where the pastor left the provided parsonage in February of this year to move into her own home, and they've designated a smaller amount than probably what she would have in her own home for 2020. So the question is, are they limited to what they designated with the expectation of her living in the parsonage for the whole year?
Yeah, I think ideally what would have happened is, in anticipation of moving out of the parsonage and into a home, right before that happened, the church would have increased the designation for the year. I mean, you can do it at any point, but it's lost opportunity the later in the year that it happens, because it's only prospective. So you can't go back and say, oh, it's June, I've discovered that the housing allowance, I really should have made it $24,000 instead of $12,000. Well, you can fix that for the remaining 6 months of the year, and you get to 18, but you don't get to the full 24 because of the half of the $12,000 increase. So, if it hasn't been increased at this point, it still could, and get a little bit of the benefit. But from that question, what I would say is what's really important is to make sure it's set at the appropriate amount for next year, starting on January 1.
Next question, how do we train tax accountants on this? Or do we have recommendations on accountants who are used to these clergy exemptions?
Ideally, you hopefully find a CPA or some other professional tax advisor who has some experience in this area, because it is kind of a niche thing. I don't know that you can just go into like Jenner & Block or H&R Block or one of the other tax preparation services and they automatically know what you're talking about, or have somebody there who knows it. Word of mouth is probably the best way to find somebody who has some experience. Check with the other clergy in the annual conference if you have some way to kind of poll to see if anybody has, or maybe the annual conference knows of someone. Short of that, the resources that we have on our website would be helpful to a CPA. Those 2 books that I mentioned, Dan Busby and Richard Hammer, would be helpful to a CPA, so you could point them in that direction. And then, of course, the IRS publication, I think the number was 517. They might have to do, they'd have to do some catch up and some self-education, but most of them could probably get there. But ideally, you'd find somebody that already has some experience. And I see there's a question about clergy couples each getting the housing exception. So it's an interesting question if you're living in different houses, that maybe you can claim and separately claim an exclusion for each of the houses. That would be definitely I think a somewhat aggressive tax position to take. And I would not do it without the advice and guidance of a professional tax advisor. But if you're both living in the same home, I think it's pretty clear you don't get the double up. You can, you get, if the actual expenses and the fair rental value are $12,000, you get to count that once and get to exclude $12,000 between the two of you. You don't each get to exclude $12,000 for a total of 24.
Related to, you had mentioned documentation that, and I'm assuming this has to do with the fair market value for that dwelling place. Is that documentation the responsibility of the pastor or the church to provide?
So I answered that question in two different ways. Let's talk about a parsonage situation where the church is providing the parsonage. The church may already have that information, or the church can certainly go out and find a real estate professional to provide that information. Ultimately, it is the responsibility of the taxpayer, which in this case would be the pastor, to know what that is. So if the church hasn't done it or isn't going to do it, then it's going to fall on the pastor to do it, because you need to know what that number is. If it's not a parsonage situation, the pastor has her own home. If you're renting, presumably you're paying fair market value for that rent, so you kind of know the answer already based on what you're actually paying, and that's also then pretty close to reflecting your actual expenses. If you are paying a mortgage instead and you own your home, you're going to need to go find somebody to give you a number, and then you would have, you would ask them to put that in a letter or something, so you would have that as a documentation. But again, ultimately, the obligation is on the taxpayer to have the records.
What's the one question? What's the maximum amount that can be paid for housing allowance?
So there is no maximum. That's a really good question. Actually, a couple times a year, I'll get a question from somewhere in the denomination of, our pastor has asked for 100% of her salary to be designated as a housing allowance. Is that something that we can do? And the short answer is yes, that is something that can be done. There is no limitation in the tax code or from the IRS on what percentage of compensation can be designated as a housing allowance. The caution that I give these churches is understand the situation before you do that. If you're telling me you have a quarter-time pastor who's getting paid $12,000 a year by your church, and they're asking for all $12,000 of that to be designated as a housing allowance, and they're also a full-time engineer, they've probably got $12,000 in actual expenses for the year. They probably live in a house that, maybe can be rented out for $12,000 or more a year. So that makes sense, probably. If you're telling me you've got a pastor who's a full-time appointment to your church and you're paying them $80,000 a year, and they're asking for all $80,000 of that to be designated as a housing allowance, I have questions. Like, is the pastor's spouse a brain surgeon, or or something, and such that they're living in a multi-million-dollar home and $80,000 in actual expenses or $80,000 in fair rental value is something that's actually possible. But so what the church needs to do is be comfortable that the request is reasonable, and that's going to vary depending on the circumstances. Because what I tell churches is, what you don't want to do is, number one, you certainly don't want to knowingly help your most prominent employee create or engage in tax fraud by trying to exclude something from income that they don't have the ability to exclude. And nor do you want to ignorantly do the same thing, because you don't want to see a headline 6 months later, pastor of fill in the blank United Methodist Church indicted for tax fraud. So if you get a question or if you get a request that seems out of whack or seems excessive, you should kind of have a sense of what's going on in your pastor's life and, you know, where they live and does it make sense. But ask some questions, have the conversation, get some comfort before you do it. And maybe you're unable to get that comfort and the response is no, we're not willing to make that big of a designation. That's okay. You don't have to do it. But if you don't do something, then they can't exclude anything because there has to be some amount of a designation. But don't do something that the church is not comfortable doing.
We got a follow up to your example you offered there. So regarding the $12,000 pastor who wants 100% of that in housing allowance, we would show all that amount as salary with zero housing allowance, and then they would sign a housing resolution showing $12,000 in a housing exclusion. Is that okay?
So in my example, in that example, $12,000, 100% designated as a housing allowance. What could happen is the W-2 at the end of the year shows $0 in the wage box. And that's fine. And we do have a sample W-2 on the tax packet website. And what the IRS likes to see happen is box 14 is where you would put the amount of the designation. And there you could report to $12,000. It's not reported as wages, but it is showing up on the W-2, on the face of the W-2 in a different box. And that's also a way to communicate a nice reminder to the pastor of this is how much we designated. So it is possible to produce a W-2 that shows $0.
What happens if the pastor doesn't spend all of the designated housing allowance on housing expenses?
If by that the question is what happens if the housing allowance turns out to be more than actual expenses and or the fair market rental value annually, then that's where the difference has to be reported on the 1040. So I'll make up some numbers. The salary is $100,000. 20,000 of that is designated as a housing allowance. So ignoring everything else that happens, pension contributions, pre-tax insurance premiums, etc., the wage box would say $80,000 on the W-2. If the pastor runs all the numbers and in doing her tax returns and realizes I can only exclude 17,000 of that 20 that was designated, I have to take the $80,000 that's reported on the W-2, add the 3 back in, and write on the wage line on the 1040 $83,000 instead of 80. So that's where the add back in possibility comes in.
Next question is, how is the housing allowance reported for Social Security purposes?
That's a good question. And as a reminder, and this speaks to one of the other special clergy tax rules, which is ministers of the gospel under the tax code are considered to be self-employed for Social Security purposes. And what I mean by that, is that they are not subject to FICA, which is a shared obligation of employer and employee. If you've ever worked at McDonald's or somewhere else, you see, half of the FICA obligation gets taken out, withheld from the employee's wages, and then the employer pays the other half. That is one tax regime for Social Security and Medicare taxes. The other one is SECA, SECA. The Self-Employed Contributions Act. That is what clergy are subject to, and per the tax, hardwired into the tax code. And so what that means is clergy need to make quarterly estimated payments for the Social Security obligations, for their SECA obligations. And so that's taxable earnings. we're getting into hyper-specific documentation, refer to the webinar where I go through this in a little bit more detail, but that's taxable earnings versus taxable income. You pay income taxes on taxable income. You pay Social Security taxes on taxable earnings. And those, for most of us who aren't clergy, those numbers are the same. For clergy, the numbers can be different and will be different because you have to add in, if you have a housing allowance, you have to add that value back in. It is counted towards taxable earnings, and thus you pay SECA taxes on it. The in-kind provision of a parsonage, the value of that parsonage gets added in if that's what you have to your taxable earnings, and thus SECA taxes apply to that. So the mechanism by which those are paid, again, is quarterly estimated payments. If that's something you're not doing, you need to be doing, again, go to the tax packet, go to one of the other resources I referenced for more information about that. There are ways to have that withheld if you want to from your paycheck. The third rule that we've talked about, housing eligibility for the housing allowance, self-employed for Social Security purposes. That's 2 of the 4 rules. The third one is exempt from withholding, federal withholding, that you can opt in and do voluntary federal withholding as a way to not only cover your income taxes, like what would happen if you were a lay employee and they were being taken out anyways, but also you can, when you fill out the W-4, to indicate your exemptions and things, and which your employer would use to calculate how much is withheld each time. There's a line that says additional amount to be withheld, and you can put in a dollar amount. A number of clergy will put in a dollar amount in that box, and that's the estimate of what they're going to have to pay for their SECA obligations. So when they do the quarterly estimated return, they show how much has already been withheld, and maybe they don't have to write a check to the IRS at the end of that 3 months because it's already been withheld from their paycheck. But that's a long-winded answer to say that's how you deal with the Social Security piece and being self-employed for that aspect. It's the quarterly estimated payments.
All right, I'm gonna try and translate this next question. Trying to simplify. So if part of the exclusion are real estate taxes factored in, does that mean that you can't use that deduction on other areas of the 1040?
That's actually quite the opposite of a dumb question. It's a very savvy question, but that is double dipping, and that is something that can happen. Paying the real estate taxes in non-taxable income and then deducting the payment of the real estate taxes to further decrease. My understanding has always been that there is nothing that precludes that quote unquote double dipping in this specific scenario.
All right. Another question: if clergy has a second home, second dwelling, maybe a vacation home, what have you, can clergy take out housing expenses on 2 homes at the same time?
That is a very easy answer of no. As much as you might want it to be different, there is a tax court ruling and that tried to go a different way, and then a federal court of appeals said no. The tax code says for a home, that means 1. So you cannot exclude income on the basis of expenses related to 2 or more homes. It is limited to 1. And thus, if you're living in a parsonage and you have a vacation home or a lake house or something like that, not going to be able to exclude expenses for that non-parsonage home.
What happens if we didn't pass a resolution at our charge conference? Can we do that when we meet in the new year?
You can. I would encourage you to do it before the new year, because that's going to not be a full designation for the calendar year. It's really important to get it done prior to January 1. That's where the in advance requirement really comes into play. I mean, if you do it on January 1, that's a minimal impact. But if it gets into January 15 or February 1 or further, then you're starting to really, you're getting into prorating what the actual designation is. And you start to get into some really hairy questions about timing of expenses and the designation that you really don't want your pastor to have to deal with. So, I mean, really get it done. If you need to have a brief meeting just to do it, do it. That's so much better than waiting till after the new year to do it, because it gets really complicated really fast. And Bob, yes, if I wasn't clear, my understanding has always been, even if you're counting the payment of real estate taxes towards what is excludable from income, you can still claim the deduction for the payment of real estate taxes elsewhere on the 1040.
I am not seeing any. Oh, wait, I spoke too soon.
All right, I'm just going to read the question out loud. So, pastor salary is 60,000. The housing allowance is 20,000 for a total of 80,000. By the way, churches do this differently. This is a great way to provide an example of that. There's nothing wrong with doing it that way, saying, pastor, your salary is 60,000, your housing allowance is 20,000. On top of that, your total cash compensation, if you will, is $80,000. You can also say your salary is $80,000 and we're designating 20,000 of that as a housing allowance. From a tax standpoint, and what's going to be excluded or not from income, it doesn't make a difference. You can do it either way. But getting back to the question, so salary is $60,000, housing allowance is 20 for a total of 80. The church can only afford $70,000 for the coming year. Can we designate all 20,000 of the housing allowance as being exempt and reduce wage to 50,000? So yeah, I guess that's the other side of my example. You can certainly say salary is $70,000, $20,000 of which we are designating as a housing allowance. It's the same end result from a tax standpoint. There are other situations in which you get into trouble if you're reducing salary and designating it as, or categorizing, let me use a word other than designate, you're categorizing it as something else like reimbursable business expenses. Don't do that. The IRS doesn't like that and the tax code doesn't like that. But in this scenario, you can do it either way. You can say your salary is 50, your housing allowance is 20, or your salary is 70, and we're designating 20 of that as a housing allowance. Same thing for this purpose. Jensen, I'm scrolling up just to see if there was
I think
anything from earlier.
I think you covered it. I'm going to post once again for everyone. I'm going to post the link to the legal services, the tax packet, the GCFA tax packet that link has the video that Bryan has mentioned a couple times. It was the full length, like in-depth webinar that was kind of the precursor to this. This is a Q&A. So that's available there, but also there's the housing allowance combined documents, which is 22 pages of information, much of which we've gone over here. So make sure you follow that link, and we'll also send that out again in the email calling this up.
I see one. The question is, my church, nope, wrong one. I scrolled too far. Is the clergy housing allowance exclusion in retirement available for licensed local pastors who retire. So this gets kind of to the fundamental thing, which again is in the webinar on the website. You don't get to the clergy tax rules at all unless two things are true for the individual. You have to be a minister as defined by the tax code, which there's a list of things that go into that. You don't have to check all the boxes. It's kind of a totality of the circumstances type of thing. Obviously, the more factors that apply, the more likely the answer is yes, you're a minister for tax purposes. But the most important one, and the one that pretty much is always required, is to be licensed, commissioned, or ordained. So a licensed local pastor would fit one of those three categories. And as long as there's enough of the other factors, they would be considered a minister. So that's one side of the coin. The other initial hurdle is whatever it is you're getting paid is in furtherance of your ministry. So you can be a fully ordained elder in the United Methodist Church, and if you work at Barnes & Noble as a cashier, you're not, whatever Barnes & Noble pays you for being a cashier is not going to be subject to the special clergy tax rules, because you're not getting paid for performing service in furtherance of your ministry. So going back to the licensed local pastor question, you've got the license piece. If you check enough of the other factors, you're probably good from that side. And then the question becomes, what is it that you're doing? What are you getting paid to do? And that's another kind of facts and circumstances balancing factor test, where the more boxes you can check, the better. But if you're serving in a kind of prototypical pastoral role at a local church, you almost certainly would meet both of those requirements. And then the final thing, because this is an in retirement question, if what you're getting in retirement is related to doing that work as an active minister, so this is your retirement through CRISP or through the annual conference or whatever the case may be, then yes. But if this is if you also happen to be an accountant and it's retirement payments from your money you earned as an accountant, then no, that can't be designated as a housing allowance. So I hope that makes sense. My church provides a parsonage. Should I claim an in-kind designation or a housing allowance? Whether you realize it or not, you're probably claiming the designation or the in-kind provision already, because you're not adding the fair rental value of the parsonage into your taxable income. It just never shows up. It doesn't have to be excluded because it's never really there, because it's not cash going into your pocket. There is a situation in which it may make sense to have a parsonage allowance designated on top of that. If you have actual expenses in relation to living in the parsonage, the church is covering everything, then there's really nothing else for you to exclude, and there's nothing to do. But if you are going to have a parsonage allowance on top of it, just make sure that somehow you're not double counting anything. And so that's just a good thing to work with your professional tax advisor on.
All right, one last question, I think, and then we're at our time. The question is, so do assigned lay people, do they apply for the housing allowance tax exemptions?
Yeah, so for example, if you're a certified lay speaker, and the terminology changes sometimes, I think that's maybe the current, but a lay supply pastor, yeah, they're not going to meet the requirements for being considered ministers from the tax code, and thus none of the special clergy tax rules would apply to them, including the housing allowance. They would not be eligible for that as an exclusion from income. So, you've got to be certified, licensed, or commissioned. A lay speaker I'm sorry, did I say certified, licensed, commissioned, or ordained are the requirements. So if you've got a certified lay speaker, that's not going to get there, both because it's certified and also because it's still lay. And so that's not going to work. And the other thing I would say, that when I do this on a larger scale, is to remind everybody, it's not a buffet of tax rules that you get to pick and choose which ones you want to follow and which ones you don't. You're either a lay employee like me and none of this applies, or you're considered to be a minister for tax purposes and all of the rules apply, whether you like it or not. So most people like the housing allowance exclusion. Not everybody likes the fact that they have to pay SECA, and they would rather have FICA withheld and then the employer pay the other half of FICA because it costs less. I get it, but that's not a discretionary thing that you get to pick and choose. All the rules apply or none of the rules apply. And if anybody's wondering, we've hit 3. If anybody's wondering what the 4th is, that's the possibility of opting out of Social Security altogether. I go through this fairly quickly in the larger presentation, 30 seconds on it right now. It doesn't really make sense for United Methodist clergy, in the sense that it has to be a religious-based exemption or objection to that type of public assistance, for lack of a better phrase. So a monk that's taken a vow of poverty says, I don't want to receive Social Security benefits. That's against my religious beliefs. The United Methodist Church, by and large, has been pro Social Security. So it would not come from a denominational perspective to have a religious-based objection to it. It would be arguing me personally, my personally held religious beliefs. I do not want this, but it is theoretically possible. It just doesn't happen in this denomination very often. And you do have to do some certification saying, under penalties of perjury, this is what is true for me. So be cautious with that. And it's an irrevocable decision. You can't opt out and then at some point say, I changed my mind, I want to get back in. Once you're out, you're out. In the past, there has been windows where people have been allowed to come back in, but there hasn't been one in a long time, and there's no guarantee it would ever happen again anyways. So those are the 4. Housing allowance, which we've talked about a lot, being self-employed for Social Security purposes, so you're subject to SECA, not FICA, exempt from income tax withholding at the federal level and probably also at the state level, because they typically follow each other, and then the possibility of opting out of Social Security altogether. So those are the 4 rules. And I think we've got it all just in
I
one.
think so. I think so.
2
Well, we're
minutes
at
to spare.
2:58. So once again, everyone that has registered for this, you'll receive an email with follow-up information. In the chat below, you can see an email address, connectionalations@gcfa.org. We at GCFA, our ministry is to support your ministry. So if you have any needs, any questions for any services, including IT, HR, communications and marketing, website design, just give that email, reach out to them at Connectional Relations, and we'll make sure to follow up and do our best to support your ministry. So thank you so much, everyone, for joining us, and have a good rest of your day.
Thanks, everyone.